Hey there, meet Will. He's just a regular guy living in America using US dollars every single day. But now Will wants to take a trip to Germany, and that's where things get confusing. He goes to exchange his money and discovers that one US dollar only gets him 90 cents in euros. Wait, what? Then he looks up Vietnam for his next adventure and finds out that one US dollar equals 25,000 Vietnamese dong. His mind is officially blown. Why does money have different values in different countries? Why isn't $1 just equal to €1 and one dong everywhere? And why do these exchange rates keep jumping around every single second? In this video, we're going to uncover the secrets behind currencies, exchange rates, and why money just isn't the same everywhere you go. Before we jump into why currencies have different values, let me take you back in time. For a really long time, money wasn't just paper with numbers on it. It was actually backed by real gold. This was called the gold standard. Basically, every dollar or pound or whatever currency had to be backed by actual gold sitting in a vault somewhere. So if a country wanted to print more money, they needed more gold first. This kept things pretty stable because governments couldn't just print money whenever they felt like it. But as the world grew, economies expanded, and especially during wars and financial crises, countries realized they didn't have enough gold to back all their money. It became impossible to keep up. So by the 1970s, most countries ditched the gold standard completely and switched to something called fiat money. Now, fiat money sounds fancy, but it's actually pretty simple. It's money that has value just because the government says it does and because people believe in it. There's no gold backing it up anymore. That's why some people jokingly call it fake money. If you want me to dive deeper into this whole fiat money thing, let me know in the comments and I'll make a whole video about it. Here's the thing about fiat money. Since it's not backed by gold or anything physical, its value depends entirely on whether people want it or not. Think of it like this. If tons of people want a certain currency, they'll compete to get it, and that drives the price up. But if nobody wants it, the value crashes. That's why currencies from strong, stable economies like the US dollar are worth more, because everyone around the world wants them. Meanwhile, currencies from struggling economies like Venezuela during its hyperinflation nightmare become almost worthless because nobody, not even Venezuelans themselves, wants to hold on to them. So the value of money really comes down to supply and demand. And in this video, we're going to explore exactly how supply and demand shape currency values. First up, let's talk about inflation. Inflation is when your currency starts losing its buying power. In simple terms, it means there's more money floating around compared to the actual goods and services available to buy. If you want to understand this better, check out my video, Why Don't We Just Print More Money? But here's the key point. When a country has high inflation, its currency loses value fast. And why would anyone want to buy or hold on to a currency that's losing value? Exactly, they wouldn't. Here's an example. Let's say in 2022, you could buy 2 loaves of bread for $10. But because of high inflation, 2 years later, in 2024, that same $10 only buys you 1 loaf of bread. You're getting less for the same amount of money. That's inflation eating away at your purchasing power. A shocking real-life example, Zimbabwe. Back in the 1980s, the Zimbabwean dollar was actually worth more than the US dollar. Can you believe that? One Zimbabwean dollar equaled 1.35 US dollars. But then everything fell apart. Failed land reforms, corruption, international sanctions, and the government printing money, like there was no tomorrow, destroyed the currency's value. By the 2000s, one US dollar was worth almost 600,000 Zimbabwean dollars. The government tried to fix it by changing the currency multiple times, but eventually they gave up and started using foreign currencies like the US dollar and South African rand instead. Though I have to say, props to Zimbabwe for never giving up. They're actually trying to bring back their own currency now. We'll see how that goes. Now let's talk about interest rates. You've probably heard this term thrown around in the news, but why does it matter so much? Simply put, interest rates are the cost of borrowing money, expressed as a percentage. If you borrow $1,000 at a 10% interest rate, you have to pay back that $1,000 plus an extra $100. Central banks like the Federal Reserve in the US are the ones who set these rates. Here's where it gets interesting. When a country raises its interest rates, it offers better returns to investors. This attracts people from all over the world who want to invest their money there. But to invest, they need to buy that country's currency first. This increases demand for the currency and makes it stronger. Let me give you an example with government bonds. When you buy a government bond, you're basically lending your money to the government for a certain period of time, and in return, they pay you interest. So let's say you buy a $1,000 government bond with a 5% interest rate for 10 years. The government takes your $1,000 and pays you $50 every year for 10 years. Pretty straightforward, right? Now here's the thing. The higher the interest rate, the higher your return. So if the US has higher interest rates than Germany, investors will sell their euros and buy US dollars to invest in American bonds or savings accounts because they'll make more money. This boosts demand for US dollars and strengthens the currency. On the flip side, if US interest rates are falling, investors get lower returns, so they start looking elsewhere. Demand for the dollar drops and its value goes down. But hold on, can't a country just set super high interest rates to attract all the investors? Well, not exactly. Remember, interest is the cost of borrowing. If interest rates are too high, it becomes really expensive for regular people and businesses to borrow money. Fewer people will buy homes, start businesses, or expand. This can slow down the entire economy and even cause unemployment. So central banks have to carefully balance interest rates based on what's happening in the economy. And that's why everyone pays such close attention when the Federal Reserve Chairman announces changes to US interest rates. It's a big deal. Next, let's look at a country's overall situation and foreign investment. When China opened up to foreign investors in the late 1970s, tons of international companies rushed in to set up shop. They built factories, hired workers, bought land, and paid for all kinds of expenses. But to do all that, they needed Chinese currency, the yuan or renminbi. This created massive demand for the yuan and made it much stronger, while pumping huge amounts of money into China's economy. That's why almost every country on earth tries to attract foreign investors. They want businesses to come in, spend money, and boost demand for their currency. But here's the catch. Foreign investors won't just invest anywhere. They look for countries with stable politics and economies. Why? Because a stable government means predictable rules and laws. Imagine if a country promises low taxes to attract businesses, but then suddenly jacks up taxes a year later. Those businesses lose money and might pull out entirely. If a country keeps changing its rules, businesses won't feel safe putting their money there. Stability matters in other ways too. If there are constant protests, strikes, or political chaos, it disrupts production and makes it hard to run a business smoothly. A stable economy is equally important because it means the currency is less likely to collapse suddenly. If a country has massive debt, runaway inflation, or keeps facing economic crises, investors worry they'll lose everything. So bottom line, a stable, predictable country attracts more investment, which keeps its currency strong. Now let's talk about exports and imports. When Japan exports cars to other countries, those buyers need Japanese yen to pay for them. This increases demand for the yen. When Japan imports coal from Australia, they need Australian dollars to buy it, which increases demand for the Australian dollar. Most countries try to export more than they import because it means other nations need their currency, making it stronger. Here's a perfect example. The US convinced major oil-producing countries like Saudi Arabia to sell oil only in US dollars. Since almost every country on the planet needs oil, they all have to get their hands on US dollars to buy it. This created massive global demand for the dollar and turned it into the world's dominant currency. It's called the petrodollar, and it's a huge reason why the US economy and global influence are so powerful. Though there are rumors that Saudi Arabia might start accepting other currencies too. I could make a whole video about that if you're interested. On the other hand, small island nations in the Pacific, like Tuvalu, don't have much to export, so their local currencies aren't widely used or in demand. Instead, they just use stronger currencies like the US dollar or Australian dollar to make trade easier. Here's a neat trick some countries use. If you want a stable, strong currency without all the hassle, just peg your currency to another country's currency. For example, Brunei, a small oil-rich country in Southeast Asia, pegs its currency one-to-one to the Singapore dollar. That means both currencies have exactly the same value. And because of this, you can actually use Singapore dollars in Brunei and Brunei dollars in Singapore interchangeably. How convenient is that? Another example is Belize, a small country next to Mexico. They peg their currency, the Belize dollar, to the US dollar at a fixed rate of 2-to-1. So 1 US dollar always equals 2 Belize dollars. If you want to exchange your money, you don't even need to check the exchange rate, just double the amount. Super easy, right? Pegging makes a currency stable and predictable, but there's a downside. The country becomes completely dependent on the stronger country's economy. If the US dollar crashes, the Belize dollar crashes with it. It's like being tied together. If one lives, the other lives. If one dies, the other dies. So those are some of the main reasons why currencies have different values. But now you might be wondering, why don't all countries just use the same currency, like a world dollar or something, so we don't have to deal with exchange rates and all this confusion? It sounds like a great idea, but it's actually way more complicated than that. Let's look at the euro as an example. It's super convenient for people living in the eurozone because they can travel across countries without needing to exchange money. But here's the catch. Every country that uses the euro has to give up control over its own monetary policy to the European Central Bank. That means individual countries can't adjust their own interest rates or print money to solve their own problems because any change affects all the other countries too. For example, when Greece had a massive financial crisis in 2009, the effects rippled across the entire Eurozone. Other countries, especially Germany, were not happy because Greece's problems became their problems too. Now imagine if the entire world used one currency. You could be living your best life and then suddenly face inflation and economic disaster just because a country thousands of miles away messed up its economy. One country's crisis would instantly become everyone's crisis. That's a huge risk. And here's another question you might have. Should we make our currency as strong as possible? Not necessarily. Different countries have different needs. For example, a country that imports a lot, like Singapore, benefits from a strong currency because it makes imports cheaper. But a country that exports a lot, like China, might actually want a weaker currency because it makes their products cheaper and more competitive in international markets. That's why China has been accused of purposely devaluing its currency to boost exports. How does that work? Well, I'll explain it in another video. If you want me to break down these topics even more, make sure to like and subscribe. Thanks so much for watching, and I'll see you in the next one.